Hey guys, welcome back to Crypto Skillet. In this video, we're going to be talking about Bitcoin and the state of the crypto market in general. Of course, right now we're at a pivotal point, and the question on everyone's mind is, have we topped for the cycle? Is this the beginning of a new bear market, and should I therefore just be focused on shorting the market now? Or is this just a normal correction before the next leg to the upside begins and the bull market resumes? Now, just based on sentiment right now, most people seem absolutely convinced that the cycle is over, the top is in, and we should all just be shorting everything into oblivion. Okay, there's obviously a lot of fear on the timeline right now. You can see here that we've reached extreme levels of fear on the Crypto Fear and Greed Index, even going as low as a score of 10 just yesterday. And objectively, the bears do have some valid reasons for suspecting that the top may be in. But there are also some very strong reasons to think that the top is not in and that we do have more upside yet to come in this cycle. And yes, I realize that to many people that might sound a little crazy right now. Okay, again, everyone is getting super emotional right now, but the key to trading is not to rely on emotions, but instead to rely on objective data to guide your decision making. And in this video, I'm going to give you my thoughts on where I think we're at. And in my analysis, I'm going to be drawing from both technical factors and from macro factors as well to help us get a better overall big picture of what's really going on. And I'm going to lay out what I think are the most convincing cases for both bulls and bears. And then of course, I'll be sharing some of the specific trade setups that I'm looking at right now and the strategies that I use to trade these market conditions. Okay, remember that as traders, the big advantage that we have over the ordinary buy and hold type investors is that we can profit when price goes down and when price goes up, and we can even profit when price moves sideways within a range. Okay, it's all about understanding market structure and tailoring your strategy accordingly. Okay, now I'm going to be primarily focusing on Bitcoin here in this video because Bitcoin tends to lead the overall crypto market. So I probably won't get into the smaller altcoins too much in this video, although I may touch on Ethereum a little bit. But again, knowing where Bitcoin is at in its cycle will greatly affect what we might expect from alts, since Bitcoin sets the stage for the entire market. So even if you're more heavily invested in alts right now, this is still absolutely critical information here. Okay, so before we jump into it, big shout out to BTCC, which is my absolute favorite trading platform. It's a non-KYC exchange with no VPN needed. So you can simply sign up and start trading from pretty much anywhere, and you can trade with up to 500x leverage, and they've got super deep liquidity. Okay, BTCC has been around since 2011, so they're one of the tried and true OG exchanges, one of the most trusted platforms out there, and they've really perfected the entire user experience. And for viewers of this channel, when you sign up using my link, you can get up to $10,000 in bonuses. Just use that link down below in the description. And I've already made a complete tutorial about exactly how to use the BTCC exchange. So if you're interested in that, I'll leave a link for that down below in the description as well. So shout out to BTCC. And of course, before we get started, hit that thumbs up if you enjoy the content and subscribe to the channel and ring the bell to get notified every time I post a new video. And do keep in mind that none of this is financial advice. I'm not a financial advisor. I'm a trader and an investor sharing my thoughts, experiences, and opinions. This is strictly for educational and entertainment purposes only, so always practice proper risk management and do your own research before making any trading or investment decisions. And now with that said, let's get into it. Okay, so to start off, I'm going to go over what I perceive to be the most convincing cases for the bears. Now, I realize that most of you have probably heard all of these. If you've been in the crypto space at all, if you've been following Bitcoin influencers or crypto influencers, or if you're on crypto Twitter, I'm sure you've heard these more than enough times. So I'm not going to spend too much time beating a dead horse, so to speak, but I will just briefly summarize what I think are actually convincing arguments here. And the first one that I'm going to mention is the 4-year cycle theory. Okay, I'm sure that most of you, if not all of you, have heard of the 4-year cycle theory. Okay, this has been talked about forever in Bitcoin, and it doesn't just apply to Bitcoin, but it also applies to other markets having to do with the 4-year business cycle, etc. But usually when people are talking about the 4-year cycle with respect to Bitcoin, it has to do with the 4-year halving cycle. Okay, every 4 years, there is a halving event, which basically just halves the amount of new Bitcoin that's introduced into supply every day. And so many people just assume that Bitcoin must follow these 4-year cycles because of that halving schedule. And now, right now, we're in November of 2025. And if we go back exactly 4 years ago, you can see that in November of 2021, this is where we had our last top. Okay, so people think, okay, exactly 4 years ago, we had our last top. So this must be the top that we're experiencing now. And therefore, we're in for a gigantic bear market, just like we saw back in 2021. Okay, now while I don't think that the halving really matters as much as it used to, I do think that there might be some validity to this idea, and it actually doesn't have really anything to do with the halving itself. Okay, because with each halving, the amount of new supply gets cut in half, and so it matters less and less each time. Okay, it has a lesser impact on the overall market dynamics. And so I really don't think that's the biggest factor here, but what might actually matter is the sort of self-fulfilling prophecy aspect of it. Okay, so if everybody assumes that it must follow this 4-year cycle, then everybody gets scared once we've reached the 4-year mark. And when people get scared and assume that it must be over, the top must be in, then they start selling, which causes the price to go down. Then other investors see the price going down, and that just sort of reassures them that yes, indeed, this 4-year cycle thing is real. The top is in, so I'm gonna sell too. And then that makes the price go down even further, and it just becomes sort of a vicious circle. Again, somewhat of a self-fulfilling prophecy kind of phenomenon. Okay, so that very well may hold some water to some degree. Now, I'm not personally convinced by that argument by itself, but it is definitely one to consider here, so that's why I'm presenting it, okay? Now, the next thing I want to point to is more of a technical one, and that is the so-called death cross that we've just experienced. Now, a death cross is when the 50-week simple moving average crosses down below the 200. So if I go ahead and adjust my moving average ribbon right here, I'll change these from EMAs to SMAs. Okay, there we go. And here you can see right here, this orange line, okay, this is the 50-week SMA, and the red line is the 200. Okay, and you can see that they are currently crossing where the orange one is going down below the red one. Okay, that is the death cross. And people generally consider that to be a bearish event. Now, I can actually point to some very strong evidence that this is in fact a quite bullish event, but I'm going to get to that in just a minute when I go over the bull case, okay? But this is one thing that you'll see a lot on X or Twitter, and you'll hear people talking about it. Of course, it has a very scary sounding name, a death cross, right? So it seems really bearish. And again, I'm going to come back to this in just a minute, but this is still worth mentioning. Okay, now the next thing I want to point to here for the bear case is if I come here to the weekly chart and then I zoom in, you can see that we have now closed a weekly candle below this 50-week SMA. Okay, now this is important because historically throughout this cycle, if you go back to about 2023, you can see that we've never closed a weekly candle below this moving average. Okay, it's bounced here, it's bounced here, it's bounced here. But then right here on last week's candle, instead of finding support and getting a bounce from that SMA, we instead closed below it. And this is definitely one of the biggest reasons that people are freaking out right now. Okay, if you go back to the end of 2021, you can see we got a weekly close below this moving average, and that was indeed the start of the next bear market. Okay, we ended up coming back, retesting it from the underside, and it was resistance at this point. And then we just continued to fall and fall until we ultimately reached the bear market lows in 2022. Okay, and you'll hear a lot of analysts talking about this. Probably most famously, Benjamin Cowan talks about this, and there are lots of others as well. Okay, so this is definitely a factor worth considering on the bear side. It's obviously not a great look, but ultimately this is a time-based factor rather than a purely structural factor. So for me personally, although I do consider it, I don't give it that much weight, honestly. I don't think it's one of the most important things, but it is still a factor worth considering, okay? So now moving on to more of a fundamental factor, we can see here from the long-term holder supply that long-term holders are now selling or taking profits. And on this chart here, the line in black is the historical price action of Bitcoin, and the line in blue is the long-term holder supply, okay? This is just the coins that have been held for at least 155 days. And what we can see with every cycle peak or every top is that the long-term holders tend to sell off into those big blow-off tops, okay? You can see it here, you can see it right here. Okay, it drops sharply as the price of Bitcoin rises up into its blow-off top. Okay, you can see it back here as well. Okay, as the price goes up to this top, we see a sharp drop in the long-term holder supply. Okay, we even saw it back here in our current cycle, and then we've seen this again right here and also right here up to where we are now. We're seeing a steep drop. Now, this is actually perfectly normal behavior. People who have been holding Bitcoin for a long time tend to sell off and take profits into those big rises, and then they tend to accumulate more Bitcoin as it cools off, and then they just repeat it all over again in the next cycle. Okay, it's very normal, typical behavior, and that really should come as no surprise. But this is where it gets important. So historically, the long-term holders were considered the diamond hands. Okay, these are people who've been holding for a long time, so they're used to the volatility of these markets, and they don't get shaken out so easily, right? Okay, again, they are long-term holders. And what has tended to happen in past cycles is that as long-term holders start selling into these sharp rises in price, well, who are they selling to? Okay, it's usually retail investors who are all caught up in the hype and the euphoria of the prices just rising and rising. But the downside to that is that those new buyers, those retail investors who are just jumping in on the enthusiasm, are not as seasoned, okay? They're not as used to the volatility. And of course, they're buying at much higher prices. And so then at the first signs of trouble, they're a lot more likely to jeet their bags and sell like paper hands, as it were. And historically, that's been a problem because when they start panic selling, it just causes further price drops, and we've seen that at the end of cycles before. Okay, now there's some very, very important nuances to this, and I'm going to get into that in just a minute when I get into the bull case, but it's still important, I think, to present this argument because you probably are hearing some of this, and in the past, I do think that would be a very relevant concern, although I think things have changed dramatically now, but again, I'm going to get into that in just a minute. Now, another point here for the bears, this is really from the macro side, has to do with rate cuts, okay? So we all know the Fed has just started cutting rates, and generally that's viewed as positive for risk on assets like Bitcoin. And for a while, everybody was assuming that it was kind of just a given that the Fed was also going to cut another 25 basis points in December. But at the last FOMC press conference, Jerome Powell came out and basically just said, no, that's definitely far from a given. They may in fact not cut rates in December. That's really yet to be determined. So the market really didn't like that. They kind of freaked out. And you can see here on Polymarket that the odds of getting another 25 basis point cut in December is down to just 44%. Okay, so the market is basically pricing in the likelihood of no change as being more likely than actually getting another rate cut. Okay, so in my opinion, those are kind of the strongest factors that are sort of playing in favor of the bears right now. But now I want to present to you what I consider to be the strongest cases for the bulls. And these are probably things that you have not heard nearly as much about, but that I think are every bit as important and worth considering here. Okay, so the first thing, and perhaps the most important thing for me and my trading system, is the Elliott Wave structure. Okay, I'm going to go back to a daily chart here. And now in Elliott Wave theory, we know that markets tend to move in these 5-wave impulses, which are then followed by corrective structures, which tend to be 3-wave moves, although they can also be complex corrections, which are just combinations of these 3-wave moves. And there's a case to be made that we had our wave 1, 2, 3, 4, and then completed a 5th here, which would have led to a corrective structure, okay? So this would have been like an A wave, a B wave, and then now we would be working on a C wave. Now there's just one big problem with that. Okay, if I get rid of these and we zoom in here, you can see that right here from these lows off about 74K up to here, we have a very, very clear impulse. Okay, and an impulse is just a series of higher highs and higher lows. And it typically looks like this. You'll get a wave 1, a wave 2, a wave 3, a wave 4, and a wave 5. Now in Elliott Wave theory, there are certain rules that apply. So wave 2 cannot go beyond the origin of wave 1. Okay, wave 4 cannot come into the territory of wave 1, and wave 3 cannot be the shortest. Okay, and within this, waves 1, 3, and 5 are impulses themselves, whereas waves 2 and 4 are corrective structures. So if you were to zoom in on waves 1, 3, and 5, you would also find little miniature impulses within them as well. Okay, and I don't want to get too much into the nitty-gritty here of Elliott Wave theory. If you guys are interested, I can make future videos about that, so just let me know in the comments. Okay, but what we see right here is a very, very clear impulsive movement. It started down here at 74K and terminated up here around 104, 105K. And what this looks like to me is a very big complex correction that's following after. And this is what's known as a WXYXZ. Okay, so from the end of this impulse, we had a W, X, Y, X, and then now we're working on finishing up this Z wave down here. Now, the reason that I favor this interpretation rather than looking at this big move up as a B wave all has to do with this little section right here. Okay, if we zoom in right here, you can see that this is a very clear 3-wave move to the upside here. Now, if this entire move up was just one big B wave, we would expect to see an impulse followed by a 3-wave correction followed by another 5-wave impulse. But instead, what we have is a 3-wave move. So to me, that completely takes the B wave interpretation off the table. And instead, this looks like the start of a new wave, okay, which at a larger degree would be an extended 5th wave. And now we're just seeing a big complex correction. And in this final move of this correction, okay, this looks like a very, very clear zigzag. That's one of the kinds of corrections, okay? You have zigzags, flats, and triangles. And so in a zigzag, it's a 5-3-5 type of structure. So you have a 5-wave move here, 1, 2, 3, 4, 5, then a 3-wave move, and then a final 5-wave move. Okay, 1, 2, 3, 4, and then now we're working on this 5th final wave. Okay, so just from looking at this alone, this actually gives me confidence that the cycle top may not be in. Okay, because if this is the correct interpretation, that means that what we would expect next is the start of a new, even bigger impulse to the upside. Now, we also know from Elliott Wave theory that the corrections tend to terminate somewhere in the neighborhood of the 4th wave of the prior impulse. And so as it looks right now, we have basically just cleaned up all these lows right here from this 4th wave of the previous impulse, which is pretty much right on target. And furthermore, if I come here and grab the rectangle tool, we can see that we have a daily fair value gap right here. So if I drag this over, you can see that we've actually just tagged that. If I go down to a lower time frame, you can see that we have just tagged into that in our last 4-hour candle. Okay, these fair value gaps are places where you often expect price to reverse. Okay, and even below that, if we were to continue correcting just a little bit further, we also have this weekly demand just below us. Okay, I'm going to the weekly chart here. And if you look at this last down move that preceded this expansion to the upside, that is our demand zone. So we can go ahead and mark this off here. I'll drag this on over. I'll change the color here to green to indicate a demand zone. Okay, you can see that that starts somewhere around 88K and it goes all the way down to the origin of the impulse around 74. So even if this fair value gap were to be breached, we still have this gigantic weekly demand right below us. Okay, so all of that points to an imminent reversal pretty soon. Now, to add further confluence to this, if I go back to the daily chart, it might be a little bit easier to see here. So we can draw the fib levels from the swing low right here at the origin of this impulse up to the very top here. And we see that price has now reached our OTE or optimal trade entry, also known as the golden pocket. Okay, this goes from the 0.618 fib level down to the 0.7 or the 0.706. And we're right smack in the middle of that right now. Okay, so again, this is the area, this golden pocket area, where price is most likely to see a bounce or to see a reversal. So that's certainly a very positive sign. Now, furthermore, if I pull up the RSI here and I go to the monthly chart, we can see something really interesting here. So we have what's called a hidden bullish divergence. So what we see here is lower lows being made on RSI, while we have higher lows being made in price. Okay, now obviously this candle has not closed yet, so yes, it could still fall farther and invalidate this, but as it looks right now, this is technically a hidden bullish divergence in the making. Now, even on these lower time frames, I'm here now on the 12-hour chart, you can see that we're getting these lower lows here on price, but if we look at RSI, we're actually getting a series of higher lows. Okay, this is just called a bullish divergence, not a hidden bullish divergence. This is just a straight up bullish divergence. And we've seen that play out on multiple time frames now. So again, this is the 12-hour, but you can also see this here on the 4-hour chart as well. Okay, we're getting these lower lows where RSI continues to go up. Okay, so all very, very good from the technical side. Okay, now another really important thing I want to point out here is a divergence that we're seeing on CVD. Okay, so this red line that you're seeing, this is spot CVD, which stands for spot cumulative volume delta. This basically just shows you the direction of market buying or selling. Okay, and what we've seen from these lows here at 74K, and really from long before that, is consistent selling pressure here from spot. Okay, it's just been going constantly down. Whereas you can see that the price during that same period of time is up from where it was at those lows. Okay, that's called a bullish divergence on CVD. And now if I bring in our perp CVD as well, this is the cumulative volume delta from perps. It's the same story, okay? It's just been going down while price is actually up from where it was. So what this indicates is absorption. Okay, this means people are market selling, but there are limit buyers that are absorbing that selling. Okay, generally that's a bullish sign. And now if I come back here to the chart on the 1-day time frame, I want to address this death cross that we mentioned earlier. So historically, death crosses have actually marked bottoms, okay? If we come back here to the beginning of this part of the cycle, you can see that we had a death cross right here, okay? And look what happened right after that, okay? That actually marked a bottom. I mean, that was right at the bottom within like a day or two. and then price rallied from there. Okay, the next time we got one was right here. So you can see there was a death cross, and look, you can see this was actually right at the Pico bottom as well, just slightly after it in this case. Okay, then we got another one over here. So if I go ahead and circle this, here was our death cross, and this was just within a couple, maybe 2 or 3 days from the absolute Pico bottom as well, and then price rallied in our latest impulse up from there. Okay, so a death cross on its own isn't really all that significant in terms of being bearish, and in fact it can even be perceived as bullish. Now there is one important caveat to that. If we go back to the last cycle, you can see that when the cycle top was indeed in, we did have a death cross right here, and we ended up getting a little bounce that just went up to the 200 SMA, but then ultimately reversed down. Okay, but in this case, the context was much different. Again, from that Elliott Wave perspective, we had a very, very clear 3-wave rise here. This is an obvious B wave, after which you would expect a big C wave. So we had a 5-wave move here. That was our C wave. We had a 3-3-5 type of correction, and that is not exactly what we're looking at now. Okay, so I don't know how many parallels we can really draw from that. And again, moving averages are really just guides. Okay, they're not really strong indicators on their own. They've got to be taken in context with other things. And now, speaking of taking in context, I also told you guys I was going to come back to this long-term holder supply thing. And I mentioned before that people have gotten concerned when you see the long-term holders selling off toward the end of cycles, because usually what happens is the paper hands come in and buy it from the diamond hands, and the paper hands get scared really easily, and so they're more likely to panic sell at the first sign of any trouble. Well, what's interesting is that now in 2025, and really throughout this entire cycle, you can see from things like social metrics that retail doesn't even seem to be here. Okay, this entire rally from 2023 up until today has really not been driven by retail at all, but instead has been driven by institutional buying. And that's really, really important in my opinion, because institutions aren't necessarily going to be paper hands. Okay, if you think about it, if people are buying this for their retirement accounts, they're probably more likely to have that sort of TradFi mentality, okay, where you buy and hold for the long term. Okay, people tend to have much longer time horizons in traditional finance than they do in crypto. So I'm actually not convinced that this is necessarily a bad thing. I think the fact that it's institutions that are really absorbing most of this, so it seems, could be a very, very bullish sign for the overall state of the market compared to past cycles. Okay, so I could definitely keep going. There's a lot more things, but to me, those are the most important things, and I don't want to make this video super long, so I'll just kind of leave it there. But now I'm going to get into how I'm planning to trade this. Okay, so here time frame is obviously very important. So as I mentioned before, I am expecting some kind of bounce in this region. And if not in this region, then we might tap into that big weekly demand that's just below us. But here very shortly, I do expect a reversal of some kind. Now, these big weekly levels often get front run, okay? You can actually see that back here. If I go to the weekly chart, okay, we had a big weekly demand zone right here. And you can see that in this correction, we just barely front ran it. So people who had their bids set right at the top of this actually just missed it because they got front run. Okay, so that does happen sometimes. Now, obviously, I'm not sure if that's going to happen in this case, but it's just worth noting. So to me right now, from what I'm seeing, I'm looking at this teal zone as being a little more significant right now. So if I'm expecting some kind of reversal, what are the criteria I would look for before getting into a long trade? Well, I would want to see some bullish signals on the lower time frames. Okay, so say on the 1 hour chart or the 4 hour chart, I would want to see something like this. Like maybe we make a low, we come up, we break market structure, come back, tag that sort of breaker area. Okay, so right into there, we end up reversing, flipping that resistance to support. And that would be an example of a low time frame bullish signal. Okay, in this cluster of consolidation, it's kind of the same story. You could probably see that better on a 4 hour chart. Okay, if we get above here, come back down, test this region, and then hold it and start reversing up. Okay, that's a really, really good start. I've actually covered that exact type of trade setup before in previous videos. It's one of my all-time favorites. Okay, and remember that when you see a reversal on a higher time frame, it's going to start out on the lower time frames. Okay, you're going to get all the evidence first on those smaller, shorter time frames before you see it play out on the bigger time frames. Okay, so that's the first thing that I would be looking for, reclaiming some key levels here and seeing some market structure break to the upside on these lower time frames. Now, in terms of the levels on higher time frames that I'd be looking for, we have this key low right here. Okay, that's at around 98K, so I would want to see that get broken and then hold above as support. Okay, we've also got a level here at 103. We've got the top of this supply zone here around 106, 107. And so these are all horizontal levels that we can use to do our level to level trading. And then ultimately, if we see a full-on reversal, there's tons of untapped liquidity here. Okay, all of these lower highs that you see right here, traders have stop losses, people who are entering shorts. This is where their stop losses are going to be, okay? They're going to naturally be above these highs. So that is liquidity that's ripe for the taking all the way up here to the all-time high, of course. Okay, but again, this would be a level-to-level kind of thing. I'd want to see this first start to show signs of reversal on the low time frames. So for example, if I saw this happening on low time frames here in this zone, in this teal zone where we're currently at, okay, like if we come here to the 1 hour chart, let's say I see this. Now that could be a trigger for me to go ahead and get long, and then I could put my stop just below this teal zone. And then if I zoom out a little bit, let's say I start by putting my take profit right here above this supply zone. Okay, already that's a 3.5R trade. Okay, so that could be like a take profit 1, and then I could leave more for a take profit 2 right here at these highs. That would be a 5.5R trade. And then if I played this all the way up to all-time highs, you're talking about a 7.8R trade. Okay, so just really, really favorable risk to reward here for longs rather than for shorts. Okay, it's natural for everybody to want to get bearish at the lows, but again, that's why we don't trade on emotions. All right, this is the kind of thing that would make longs far more favorable and far more potentially profitable. Okay, now what would make this even stronger, in my opinion, is if we actually see not just a reversal, but a reversal with the structure of an impulse on lower time frames as well. Again, if this particular Elliott Wave interpretation is correct, then we would need to see an impulse start to form after this. Okay, so again, that's about the structure of the upward move, not just about the upward move itself or the extent of the upward move. Okay, we'd want to see that 5-wave impulsive structure forming on lower time frames first, and that would be a very good indication that we may be starting the next larger impulsive move to the upside, at which point we could expect all-time highs and beyond. So that's yet another thing to look for here, and if I was to see that, I would even consider compounding after the first sign of the impulse with my stop just below the origin of the impulse, and that would allow me to take on an even greater position size with a very, very clear level of invalidation. Okay, now if we don't see an impulsive type of move forming, but instead it looks like more of a corrective move up that we get, then here is the level that I would be watching. I'd be looking for this weekly order block here. Okay, I'm going to change this color to red. This would be weekly supply. Okay, so this starts at about 106.7K and goes up to about 115.5K. So if we got a move that went up here that was not impulsive in its structure, this is the area where I would be looking to take profits on my long and potentially even look for reasons to get short. And so it would just kind of be the inverse of the signs that I was looking for down here to get long. So I would go to the lower time frames, I would look for market structure breaks, which would then give me signals to get short, again with a clear invalidation level. Okay, and those clear levels are what allow me to play both sides of these trades. Okay, so those are some of the things I'm looking for on Bitcoin. That's how I'm planning to trade this. Now, I did mention that I'm going to touch on Ethereum just a little bit. And what I think is really noteworthy here is the ETH BTC chart. So you can see I've got this demand zone marked out here. Okay, we've actually just tapped into this weekly demand zone. And of course, in these demand zones, these are the most likely areas where we could expect a reversal. So this is showing the chart of Ethereum versus Bitcoin. So if this chart starts to go up, that means that Ethereum would be outperforming Bitcoin. So in other words, if Bitcoin is about to make a big reversal to the upside, based on this chart, I would expect Ethereum to reverse even more to the upside. Okay, so taking both of those charts together, both the Bitcoin USD chart and the ETH Bitcoin chart, this tells me that if it's a good idea to be getting long on Bitcoin, then it might be an even better idea with even more R to R to be long on Ethereum, maybe in addition to Bitcoin. Okay, and we can look at the ETH USD chart, and on this chart, we've clearly had this impulsive rise. And it looks like we're just making a corrective structure after this big impulse up. We're currently right here in this demand zone. You can see this little cluster of consolidation right in here. And that's currently where we're at. Plus, we're right here just shy of this larger demand zone. So if I drag that over, change the color to green, you can see we haven't quite tapped that, but it looks like we're really right on the cusp. And again, sometimes these larger demand zones get front run anyway. So there's enough confluence here for me to be looking for reasons to get long on Ethereum as well. Okay, so it's the same idea. I would come here to the lower time frames and I'd be looking for some kind of market structure break or reclaim of a key level. Okay, so if I'm seeing this come down here and then eventually come back up, maybe take out some of these highs, come back, hold that as support, and then start to send. Okay, that would be a valid reason for me to consider getting long on Ethereum with my stop just below the lows. And in terms of liquidity, we can see here that we've got quite a lot of liquidity here that's yet to be taken on Ethereum as well. So all these lower highs here, okay, these are all untapped liquidity. We've actually got these relatively equal highs right there. Looks really juicy, all the way up to basically all-time highs. So again, a lot of areas where we could put take profit levels as well, and potentially consider compounding if we're seeing impulsive structure. Okay, so that's the gist of what I'm seeing on ETH right now. Again, I don't want to make this video too long, so I'm going to go ahead and cut it off right here, guys. But basically, I just wanted to present this information to you because I'm sure most of you guys are getting lots and lots of bearish information. Okay, everybody's freaking out, getting all emotional. I'm sure you're hearing all the reasons in the world why the cycle's over and the top is in. And again, it very well may be. I'm not saying that it's not. But what I am saying is that you need to also consider these reasons that the bulls have for thinking that maybe the cycle top is not in, and look at these specific factors and these specific levels that we're actually now reaching, where it kind of makes less sense to be a bear, at least in the short term, and makes more sense to be looking for a reversal, even if it is only on the lower time frames. Okay, you just don't want to be shorting at the lows. Okay, after the bulk of the move is already done, when everybody is max bearish, that's actually when it makes the least sense to be a bear. Okay, so I hope you found this information helpful, guys. If you liked the video, go ahead and give me a thumbs up, and make sure you subscribe to the channel and hit the notification bell so you never miss out on a future video. And again, if you do want to trade, you can get signed up to BTCC with my link down below in the description. They've got insane bonuses. You can get up to $10,000 in bonuses. So big shout out to them, and big shout out to all you guys for the support. Again, remember to always use proper risk management in your trading. And with that said, that's all for now, guys. Thanks so much for watching. We'll see you in the next video.